So the first thing we're going to talk about is distinguishing the difference between a service company and a merchandising company. Who can tell me what the difference is? And don't be turning your slides and looking at the answer. All right, what's the difference between a service company and a merchandising company?
Merchandise company, you sell the product.
Okay.
And then service company, you sell the service.
Exactly. And what have we been talking about up until now? What type of company? A service company. We've been talking about me, right? I provide a service, but what does a bookstore do? They provide merchandise. We haven't talked a lot about the bookstore, have we? We've talked about me. We talked about lawyers, right? We've talked about accountants. So there's a big difference in the sense that, one too many, that now we have to look at this aspect. What are we going to do with this? You guys have seen it on the trial balance, and we've seen inventory listed as an asset, a current asset, but we haven't done much with it. So now when we look at the balance sheet, we have a lot of supplies here at the college. And I've joked about whenever we talked about supplies and how we use them up, I always hold up our marker, right? But a merchandising company like Walmart has inventory. That is not a supply. Do they also have supplies? Yeah, but they have inventory as well. So then you move down to the income statement. The income statement, you have revenue and you have expenses. There's no inventory. There's no cost of goods sold. Income statement is going to have, for a merchandising company, cost of goods sold. And you guys had that as a little sample when we did the Home Depot trial balance. Cost of goods sold is a type of expense that you subtract to get to what number? Sales minus cost of goods sold gives us, no,
Gross profit.
gross profit. Gross profit. That $29,700 right here, and it's actually million, but that number is the most money Walmart can make. All right, because they've already spent the $87.5 million to buy the goods before they sell it. So that's the most money they can make. You have to look at that gross income. So we have two different types of inventory. We have periodic and perpetual. What's the difference? Someone else besides Faja. No, that's not a bad thing.
No, thank God this was a hard question. Thank God.
What's the difference between perpetual and periodic?
The period of time.
What? The period of time. You're on the right path. So what do you mean period of time?
Perpetual, maybe it's like yearly or...
You got the right idea, but you got them backwards. Okay? So periodic is more yearly or at a period of time. You only know what's in inventory when you go and count it. That's how all inventory used to be. Perpetual is ongoing. You always know what's in it. And why are most inventories now able to be perpetual? What made them? What was it? Computers. Right? We couldn't do perpetual inventory until we had the use of scanners. Now when you go somewhere and you want to find out if they have the one green Power Ranger that you have to find before Christmas, right, because that's what Santa got asked for, can you go in and find out if Target has it? More than likely, right? Sometimes they're not right, but you can go and ask. So inventory is the total. Then you get the sales price. You subtract that cost of goods sold to get that gross profit. So this is a very important formula. You can draw it like that, but I recommend you draw it like this. You have beginning inventory. You're going to add in purchases. And the reason I recommend you draw it like this is because it's easier to do mathematically than this guy. When you add in your purchases, you get something called cost of goods available for sale. And I'll say that again because I don't write that out. It's also written right here. Beginning inventory plus purchases gives you cost of goods available for sale. That's the most you can sell. You cannot sell more than you have. Make sense? If you do, it's called back order. Right? Then you're going to subtract your cost of goods sold. Cost of goods available for sale. Subtract the cost of your goods that you sold, and what you have left is ending inventory. Now, these two can be flipped around very easily. Because this is a perpetual inventory system, because we know all these numbers. We know what's in inventory, we know what we bought, therefore we know how much we have to sell, and we know what we sold, therefore we always know how much is in ending inventory. If you go up to any company that's perpetual, you can say, Lucas, how much do we have in inventory? And you'll be able to pull it up and say, this is how much. Boom. But in a periodic, we don't. So in a periodic inventory system, cost of goods available for sale you would actually have to go count ending inventory to come up with your cost of goods sold, because you don't know what's there. You don't know what's in a periodic inventory system until you go count. And just kind of an example of a periodic inventory, if you can think of a big nursery. When I say nursery, I don't mean kids, I mean plants, gardens, all right? If you think of a big nursery, when you go and you say, "Hat, I'm looking for an apple tree," I'm not good with plants, okay? And do you have one? Their answer usually is not going to be to pull it up on a computer. They're going to say, "Let's walk out here." And they're going to go out there and they're going to be like, "I have 2. They're not going to know until they walk you out there, because they don't know. When they're out, because obviously apple trees grow, correct? And so they're not going to have another one until they have either another shipment come in or till the next year. If you're looking for a certain type of flower, you're going to walk out and find out. Now at Home Depot, they're going to scan it. They're going to have a better idea if they have that. But at a true nursery only, there's a big one off 55, Bayer's Nursery. There's other ones, but I just think of that one every time you go by because I've been there. If you want something specific, they walk you to where that area would be. We will use this form this way most of the time, but the way I want you to think about this is as long as you have 3 of these, you can always figure out the other 2. As long as you have 3, you can plug in the numbers to get the other 2. The other one we already kind of jumped by, but you have sales or net sales, and we'll expand on that, minus cost of goods sold. My writing's bad. Gives you gross profit. 2 things you just need to get in your head and memorize. All right, sales minus cost of goods sold. Now, what is net sales? We will talk a lot about that in this chapter. So the next couple slides talk about inventory. Notice in this formula, they drop off this cost of goods sold, available for sale, cost of goods available for sale. It's still here. It's still right in there, but they drop it off. I don't like it. So I will tell you to focus on this slide right here where it's at. And the reason they have the 2 branching out is to cover periodic and perpetual. They don't include it down here either, but it's still in there, that 15,000. It makes your math a lot easier if you just go ahead and use cost of goods available for sale. All right, so there's perpetual and there's periodic. And as we mentioned, periodic, no up-to-date records. Now, and perpetual has constant update. Now, if you're using a perpetual, does that mean you never have to go count? You still have to count. Why? You got to check once in a while. There could be an error. What kind of errors could we have? Theft. That's one.
It's overcounting or undercounting of the system.
The system mistakes. Damaged goods. All right? Theft, damaged goods. The other thing that happens a lot is items being misplaced. Remember how I just said that one Power Ranger, green Power Ranger at Target? If they tell me when I walk in that they have 1, what are the odds that they have 1 in the place that they say they have it? Right? If you're at one store and they tell you, okay, the Brentwood location has 1, I'm going to say the odds are slim to none that there's going to be 1 there. By the time I get there, number 1, it could be sold. 2, it could be damaged, misplaced, stolen, or behind the customer service ready to be put back. The chances of it actually being where it's supposed to be are very slim. And when my kids were little, they were part of that problem. All right? So it doesn't have to be theft for it not to be in the right location. All right, so let's look at a couple problems, but I do want to mention 2 things that aren't in these slides right now. First thing, and we'll talk about this a little bit later too, but what does it mean to be on consignment? What does the word consignment mean? Now this class has more women than men, so I would expect women to know what the word consignment. Nope, and I say that and Lucas answers for you guys. What's a consignment store? You guys don't know what a consignment store is? Nobody? Oh my goodness. I guess that's a generational thing. I don't know. Okay. So a consignment store is where you take clothes and they sell it for you. And then you get part of the money, and the store keeps part of the money. Now, it's not any clothes, okay? They have to be like Plato's Closet, exactly. Or Once Upon a Time does children's clothes. There they actually, I think, flat out buy it. I'm not sure. All right? And you get a piece of it. My question is, who owns the clothes?
The store.
The store owns it, but they're going to give you part of the money.
But they will sell it.
They're selling it for you.
You own it. You can go in the store and take it back if you want.
Exactly. You still own it. Things on consignment are owned by the person who put them in the consignment store. So things on consignment are owned by the company who gave them to the consignment store to sell. All right? That's the first thing. Second thing is you get to witness my pretty drawings. All right. When something is shipped, we have two types of shipping. All right, these are my little trucks. And this is our warehouse. All right, this is the seller. All right, when the seller sells an item and it leaves the warehouse, it's going to the buyer. We have FOB shipping point. All right, FOB shipping point says when it leaves the dock, it becomes responsibility of the buyer. As soon as it leaves this shipping point, it is the buyer's responsibility. So whatever happens to that item on transit, it's the buyer. Buyer pays the shipping, it's the buyer's responsibility. That's FOB shipping point. The other one is called FOB destination, and it says that while on track to the buyer, it is the shipper's shipping responsibility. All right, FOB destination, you keep it until it hits the buyer, the destination. FOB shipping point, you pay, the shipper, the buyer pays, and the buyer is responsible. Who knows what FOB stands for?
Free on board.
Freight on board. All right. And we'll talk about that again, but that's something just kind of introduced right now. All right, let's look at a couple quick problems. Go to your handouts, which you should have, and go to the first page of chapter 6. And do 3 quick questions. There we go. Lose this case. All right, so let's go ahead and look at what some purchasing journal entries look like. So when we go out, maybe, there we go. When we go out and do journal entries, we have to figure out what is going on. So the first thing that we're going to look at, and when I redid these slides, you're getting more information than I'd prefer for you to get. Normally I wouldn't drop down this first piece of information, but the first thing says Walmart received $10,500 worth of bikes. So the journal entry is going to be whenever you buy anything using a perpetual inventory system, it goes directly into inventory. So in this example, it would be inventory 10,500, and that's what we would write. And I left it blank on purpose, but I needed to take out the inventory and accounts payable, so that you would then have inventory accounts payable written right below it. That's the journal entry that you want, just like that. What about if we paid $400 cash to a trucker to deliver those bikes? It would go into inventory and what? Cash. Why did we take that into inventory? You're right. Well, we paid a trucker. We're not receiving inventory.
Because you include the cost of.
If this is my inventory account and it just went up $10,500 worth of bikes, if it costs me $400 to deliver it, if I sell those bikes for $11,000, did I make $500 or did I make $100?
Yeah, 100.
Made $100. So you have to include, if you're buying something, the cost of the freight is included in the price of the item. Otherwise, you're not getting the true cost of how much you make. All right. Now, what about if Walmart returned one of those bikes?
Decrease the inventory.
Okay. Decrease inventory. The bike, I think, was $500. Increase, or that decreased inventory, what are we going to debit?
Accounts payable.
Accounts payable. It's not going to be cash because we didn't buy it on cash. All right, so we're going to debit accounts payable for 500 and credit inventory. Now, let me back up. Now, this is in your slides, but without looking at what the answer is, do you guys know what that means? All right, the 2 stands for
Discount.
discount. 2% discount if what? If paid in 10 days. What's the rest of it mean?
You have to pay full price.
You have to pay for
After.
60 days.
You have to pay the rest of it within 60 days. All right, so the discount is the first number. That amount has to be paid in 30 days. The net of it has to be paid in 60. Now that example is 230. All right, that's the standard now. The standard used to be 210 net 30. Now it's 230 net 60. All right, not near as many companies are taking advantage of the discount as they used to. All right, can't answer that why. My guess is it's just not worth it. They need to retain their cash as long as they can. The discount's not there anymore. But there's other ones. 230 net 60 is the common. It used to be 210 net 30. It could be 115 net 45. It could be whatever the company wants to make it. The whole purpose behind the discount is what?
To get the money in quick time. like-
Yes, to get whoever owes you the money to pay you as soon as possible. Because the sooner you get the money, the less time you have to spend collecting the money. All right? And the more time you have to spend collecting the money, the more resources you have to spend collecting the money. And the more resources you spend, the more money you spend collecting the money. So you're trying to incent people. And I always laugh because the incentive has to be enough that someone actually wants to do it. A very lame incentive is not going to induce people to do it. All right? And my computer is going to die. So you have to have the incentive there for people to want to do it. It has to be enough to do it. So here's an example of a discount. All right, Walmart purchased bikes, $10,500, terms $230, net $60. And the thing you need to remember is Walmart returned bikes. So if we're looking at Walmart paying this bill, I'm giving you the fact that it's cash, inventory, and accounts payable. But I'm not giving you the amounts. It's cash, debited, or credited. We're paying a bill. Credited. So we're going to credit cash. What are we going to do to accounts payable? We're going to debit accounts payable. So then inventory is what purpose? It's our discount. All right? Because if we get a discount, what did we just do? We saved money, which is going to make us more money in the long run, right? So let's figure out our discount. We owe Walmart, which actually we didn't do the return, did we? Oh yeah, we did. Okay. So how much do we owe Walmart right now? $10,000. So this is accounts payable. We owed Walmart $10,500. We returned $500, so we owe them $10,000. If they're going to give us a 2% discount, how much is 2% discount on $10,000? $200. What are we going to debit accounts payable for?
9,800.
All right. How much?
8,000.
8,000?
No, because
It's just
98.
It's 9,800.
9,800? If we do that, this is what it's going to look like. If we debit it for 9,800, it's going to look like we still owe them $200. Do we still owe them $200? No. We are going to debit accounts payable for $10,000 because we don't owe Walmart any money. We are going to credit cash for $9,800 because that's what we're paying them, right? The $200 difference goes to inventory because we saved $200, meaning that it was $10,900. We returned $500 plus we got a discount, so our inventory is actually worth $10,200. We can actually make more money now because we saved money. Dang it! Hang on. My computer died. That's why you guys lost it. I gotta